That is the closing bell on Wall Street, and now it's market domination overtime. We are giving you full team coverage of all the moves to get you up to speed on the action from today's trade. We got RSM Chief Economist Joe Brusuelas, as well as Yahoo Finance's Jennifer Schonberger and Jared Blickery joining us here to break down the top stories today. Jared, my friend, let's start with you on that close.
Down day in the markets, down week, and let's just go quickly to the Wi-Fi Interactive here. I know we got some breaking news on the Federal Reserve we want to get to, but here in the Dow, we lost basically 3 percentage points this week over the last 5 days. NASDAQ a little bit better, only down about 2.17%. Russell, we'll get to that in a second. And then the S&P 500, 2.36%. And let's get some small cap action as well. That was the worst by far, down 4%. Also, the biggest drop in yields in months. You can see the 10-year down to 4.2%, but I'm not going to linger on the bond market. I do want to get to some of the sector action, and it was only the defensive sectors in the green. So healthcare led the way up about 0.5%, staples close behind, utilities a little green, but consumer discretionary, tech, both of those down 2%, energy and financials also underperforming. And I'll leave it here with a picture of the NASDAQ 100 worth 1,000 words, Amazon and Meta taking center stage down deep red for them, 8 and 3%, and not a lot of green here, but we do see Costco in the upper right up about 1.5%.
All right, thank you, Jared. Well, breaking news now turn to Federal Reserve Governor Adriana Kugler is stepping down from her position on the central bank's board. The resignation is effective 1 week from today. Our Fed correspondent, Jennifer Schonberger, joins us live with the very latest. Jen.
That's right, Josh. Fed Governor Adriana Kugler has turned in her resignation letter to President Trump. Her resignation will be effective August 8th. Kugler, who has served on the Federal Reserve Board of Governors since September of 2023, will return to Georgetown University this fall as a professor. She wrote in her letter of resignation, quote, "It has been an honor of a lifetime to serve on the Board of Governors of the Federal Reserve System." She went on to say, "I am especially honored to have served during a critical time in achieving our dual mandate of bringing down prices and keeping a strong and resilient labor market." Now, Josh, Kugler's term was not set to end until January 31st. That leaves an opening earlier than thought for President Trump to fill the board.
So, Jen, why? Why did she step down?
Well, that's the $64,000 question. It's unclear. This does come after she was not present at the Federal Reserve policy meeting this past week due to a personal matter. So this could be a personal issue associated with the governor. It is it's not clear whether it is personal or there's something else that may be happening here, but it's not uncommon, I should say, to see a Fed governor step down before his or her term is over. This does, as I said, offer an opportunity for the president to fill that position with somebody that he is eyeing to potentially be the next Federal Reserve chair and sort of offer a trial period. We know that Fed Chair Jay Powell's term does not end until May 2026. So we know that the two Kevins, Kevin Warsh and Kevin Hassett, are supposedly in the top running. It'll be interesting to see if one of those Kevins are nominated to replace Kugler.
We shall see. All right, Jen, thank you. Joe, I want to get your thoughts on this, your reaction to the headline, Joe, and what happens next? Who gets that seat?
We're going to get a shadow chair whether we want it or not is my first reaction. My sense is the risk-averse move would be Kevin Hassett. He's a former Fed economist. I'm sure he'd have very little problem getting confirmed in the U.S. Senate. However, if the Trump administration really wants to roll the dice here, if the president could talk Scott Bessent into taking the job, boy, would we have a very interesting period of Fed meetings going forward. That would be must-see TV at this point.
Joe, bottom line is for investors listening right now, they're looking at this headline. What does it mean for them, Joe? What's the big takeaway?
I think what it means is that the pressure on the Fed to cut rates is going to intensify. The assault on the independence of the Fed is going to intensify. And I think that it wouldn't be surprising if investors begin to price in a much more pronounced period of rate cuts going forward based on the fact that the Fed's going to get their the administration's going to get their shadow Fed chair, and they're likely to get it in the next couple of weeks.
To be clear, Joe, You were saying earlier, odds of a cut, in your opinion, went up for September, but not a done deal.
No, not at all. We've got too much inflation and employment data in front of us. And if we get a situation where we're adding 50 to 100,000 jobs per month, but you see inflation really beginning to accelerate, there's no guarantee that we'll get that Fed rate cut, which when I got in the car to come over here, it looked like an 85% probability for September. And hey guys, it was below 40% at 8 a.m. this morning.
All right, Joe, you're going to stick around because we need you on this other segment as well, my friend. Turning out to the dollar index, it's seen many swings, we know, amid economic uncertainty. Joe, you highlight what the moves in the currency mean for inflation. Walk us through that.
All right, when you get a sustained 10% decline in the value of the dollar, typically you should expect to see a 0.5% increase in inflation over the next 6 to 12 months. We clearly are at that point. Even though we had a nice rebound, I think it was 3.3% for the month of July, strongest month for the greenback this year. But nevertheless, the policy mix out of the administration all points towards a weaker dollar, and I think that's what we're going to get. Moreover, when you take a look at import prices, especially import prices ex-petroleum, it tells the tale. We're going to see more inflation and a weaker dollar going forward.
Does Trump want a strong dollar?
I would think he does, and I think like all politicians, he wants to have his cake and eat it too. He doesn't want de-dollarization, clearly. But he wants a weaker dollar because A, it really tends to juice the tech sector, and B, it will provide relief to the beleaguered manufacturing sector that's been in an effective recession for the past couple of years.
Is it too soon to say the kind of impact the softer dollars had during this earnings season, particularly what it's meant for the multinationals?
It's way too early to jump on that bandwagon. I think we're really going to be talking the fourth quarter earnings and then next year. Moreover, a lot of those firms that he wants to help are actually having real problems with the tariff issue because 45% of everything we import goes into domestic manufacturing. So policies that are cross purposes a good portion of the time this year, which is why that economy's slowed to 1.2% growth in the first half of the year. And we think it's not going to do much better. Our forecast for this year is 1.1%.
Can I ask you, when we talk about these tariff policies, we've been talking about them all show, there's the near to intermediate impact. But how long do we have to wait to see what the long-term impact is? Meaning, do I have to wait does it have to be August 2026 and Joe and Josh are back on set for me to really know, okay, it's really boosted manufacturing job. It's really opened up all these new markets for American business. It's really raised this much revenue.
It's a little worse, actually. So as of midnight last night, once we get to October 5th, we're going to have an effective 18.3% tariff. The real problem is we won't really understand what any of this means, not till October 5th, 2026, but more like October 5th, 2027.
Why? Why do you say that, Joe?
Because it takes so long to pass through the tariff costs. There are 4 points along the chain. You've got your retail, you've got your consumers, you've got your importers, and you've got your exporters. At each point of the supply chain, you're going to see a bit of it absorbed, a bit of it eaten. When we went through this in 2018, for example, we didn't see the full price of the increase in the price of washing machines, dryers, and dishwashers caused by tariffs show up on consumers' balance sheets until about 2 years later. Turned out 90% of that cost was eaten entirely by consumers.
So when we talk about where the cost falls on the value chain, and there's this big debate, maybe it's really the key debate inside the Fed, tell me if I'm wrong, but this debate about whether the tariff-induced inflation is one-time or transitory persistent, even if it's one time, it could go on for some time. Is that part of the point?
Well, that's right, and that's why they've been counseling patience, because you just don't know. Right now, for all of the noise, right, the tariff rate that's showing up, which is causing revenues to rise, right, and from the Trump administration's point of view, that's an absolutely good thing. It's about 8.85%. It's not 30, it's not 50, it's not 15. But as we get into mid-October, it'll be closer to 20 is my sense, because we're still not done with Mexico and we're still not done with China, and then USMCA has to be renegotiated next year. So this is going to be a variable target. It's going to be a moving target, but nevertheless, if you cause the average price of goods imported in the United States to rise by 18.3%, that's going to be eaten. And here's why we say that. There's a lot of talk that, well, foreign exporters are just eating the price. they're going to engage in invoice pricing. If that was the case, import prices would be falling significantly. They're not. They're actually rising. So that's just not happening. That means it's not the exporter. It's going to be the importer, so the retail, or the consumer, those points on the chain where those are going to be eaten.
Joe, I can honestly say that given the news flow today, you were the perfect guy to be sitting in that
That's
chair.
very kind of you to say. Thank you.
Thank you, sir. Thank you so much, Joe. Meanwhile, we move on. Berkshire Hathaway has underperformed in the second quarter, fallen over 10% since Warren Buffett's announced his intention to retire as CEO and elevate current Vice Chairman Greg Abel in his place. The conglomerate, with big stakes, of course, in Kraft Heinz, Occidental Petroleum, American Express, set to report quarterly results August 4th. Is now a good time to buy shares on recent weakness? Well, here with more on that very question, we got Bill Stone, the Glenview Trust Company Chief Investment Officer. Bill, always great to see you. Maybe, Bill, let's start with the stock here. It is down about 12% here, Bill, since that annual meeting back in May. Why is that, Bill? What's going on there?
Well, I know some people say it's because, Warren Buffett, said he was going to step down as CEO at the end of the year. I actually think it has a lot more to do with the macro environment. When you look at it, you could almost lay it right on top of kind of the outperformance of Berkshire at the beginning of the year came as the worries around tariffs and the economy rose. The stock just really took off. And then as, kind of in that May period, which just happened to fall, like you said, in that same period when the meeting was, then as that receded, then the stock went, really started to underperform. I just think of it as Berkshire's kind of the perfect stock to own when you're worried about the world for two reasons. One is this massive amount of cash they hold, but two is because you expect they should be able to take advantage of it if in fact you get big sell-offs in the market or dislocations. When you're not as worried about that, like we haven't been here for the last quarter, you're not as excited about Berkshire Hathaway.
Well, let me ask you, Bill. Buffett is stepping down. Greg Abel taking the reins. As a shareholder, how do you feel about that changing of the guard?
Well, you can't, follow the goat and expect to feel good about it. I do think Greg has shown up as a very good operator. In fact, I think you could argue probably a better operator than Buffett, because frankly, Buffett doesn't want to spend his time operating businesses necessarily or getting into the weeds of them. So I think he's very competent, and for a company that is already so large, I think there's already been some distinct benefits from having him already take on a much larger role. Again, would I rather Buffett was going to live forever and keep running it? Of course, but I can't have that.
Do you think this weakness, Bill, in the stock, buying opportunity in your opinion?
Yeah, I think it's back to a point where you can feel pretty good about owning it. We're back down to 1.5 times book, still maybe a little rich. That would, the way I kind of think of it is I would suspect we won't see any buybacks, stock buybacks from Berkshire Hathaway. I kind of frankly just try and, essentially I get more interested as I suspect they're getting more interested, because they're the ones that know the intrinsic value certainly even better than I do. But I don't think you're crazy here. When it got up to like 1.8 times book, it was an expensive stock, not that it's a reason to sell it. It's just probably was a reason to slow down owning it. I think now you can be back to at least slowly get, grabbing some as you go.
What do you expect to see the earnings results, Bill?
I don't think they're going to be great. Obviously the headline, all of the stock increases show up there. Although I will say a lot of their big holdings didn't have a good quarter in the second quarter. So like Apple was down in the second quarter, Chevron, Occidental Petroleum. They did have nice moves out of Bank of America and American Express. But anyway, set that aside. I think if you really are looking at the stock, you don't pay much attention to the headline earnings numbers. You really have to look at operating earnings. Those are likely to be not great, probably, in terms of year over year. They may actually even be down year over year. What it really will be is probably a solid, report out of the insurance sector, because you can pretty much bank on that they'll have a nice amount of interest income off the amount of cash they're holding. But then on the other side, they're going to have almost certainly some, pain on the housing related companies they own and the retailing companies that they own. So tough to see how it all plays out. Again, doesn't get me overly upset. I know it's a very diversified company. We'll see how I mean, I also should say the railroad's probably not going to have great numbers, although it could be okay. Again, it's really hard with Berkshire because they don't give you any guidance and really give you no clues. So you're really working in the dark other than trying to look at what other companies in those industries have done, or maybe we've seen their earnings and back into it a little bit.
You know, another question I have for you was, it was just that the mountain of cash obviously Berkshire sits on, and listen, investors they're gonna trust Buffett to sit on that kind of mountain of cash, greatest value investor of all time, the Oracle himself. But with Greg Abel, do you think he steps in here and makes changes in terms of how Berkshire thinks about allocating capital?
I think, I always think of it as you're exactly right with what you're saying. Warren Buffett gets way more room than any other CEO on the planet, and rightly so. Again, he's earned it, right? Abel comes in, and I suspect they'll give him some time, but I would certainly expect there'll be agitation, right? If the view is that he's just going to sit on it, or at least give some out or whatever you want to say, you're right. I mean, it's a little tougher right now because, I think Buffett and company and I was actually happy when the stock was a bit lower, in the sense of they could use a lot of that cash or some portion of that cash to buy back shares, and that makes it a essentially cheaper way to kind of, raise earnings and actually create value. At the moment, that leverage or that lever, I believe, is off the table. Like I said, I don't think you'll see any of that. So maybe he'll, I'll say, quote unquote, get lucky into having some opportunities to deploy capital that way. Or, hey, maybe a big deal. The guy certainly was involved in, big part of Berkshire Hathaway Energy and those things. So he knows how to make a deal.
Yeah, he's got the operations background for sure. Bill, thank you so much for your time. Appreciate it.
Thank you.
Well, coming up on Market Domination Overtime, Yahoo Finance's latest installation of Trumponomics with Rick Newman. Stick with us. Well, economists have been warning that President Trump's trade wars will depress growth and hiring. Trump disagrees, but does the weakness in the latest jobs report give these warnings more weight? Here with more is Yahoo Finance senior columnist Rick Newman. Rick.
Hey, Josh. Well, yeah, I think what we're seeing in the economy, not just the jobs report, but also the GDP report on economic growth for the first half and other things. I mean, this is exactly what you would expect to happen when you put tariffs on $3 trillion worth of imports, which makes them more expensive, which means spending goes down, investment goes down, hiring goes down. So let's just talk about the job numbers for a minute. I mean, a very weak showing for July, and then the big revisions for the 2 prior months. Job growth is way, way below what it was this time last year. And that is what you would expect companies to do when we have so much uncertainty. I mean, that's the uncertainty premium, which is companies just sit tight. It's going to show up also in spending and investment in coming months. So it's not surprising to anybody except, I guess, Donald Trump. And I think we can infer that he's getting jittery because of this ridiculous move that he shot the messenger by firing the commissioner of the Bureau of Labor Statistics. The problem is not the data. The problem is the policy. But we're going to trundle forward with this, obviously, for many more months. And
Trump posting on social media in response to the jobs report, Rick, drop the rate, he posted. Given the weakness you're pointing out to there in the GDP report, the jobs report, Rick, is he right? Is this a reason now that the Fed should get going, drop the rate?
I mean, that's what the market thinks. I mean, the odds of a rate cut in September shot up. I think it's now over 80% likelihood, according to the CME FedWatch tool. But Trump is still not going to get what he wants from the Fed, because he wants the Fed to cut by 3 percentage points tomorrow. That would be an unprecedented and panicky move, which the Fed is not going to do. I mean, if we see, more terrible data like we saw in the jobs report, I guess it's reasonable that the Fed could cut by 0.5 point rather than the traditional 1/4 point cut in September. But I don't think it. Let's say the Fed is a little bit behind. There's all this speculation. Should the Fed have seen this bad jobs report coming? It doesn't make that much difference if the Fed cuts in July or September. And remember, they can cut quickly if they have to. But you know what? Broaden it out. I'm still not seeing anybody predicting a recession. And I looked at the Polymarket prediction odds today. Recession odds. They're very low. I mean, they got as high as 67%, I think, in April when Trump was at maximum tariff. They're now, I think, below 20%. So people are not freaking out about a recession. We just are getting a soft patch here. We'll see if it gets worse.
We shall indeed. Rick, thank you, sir. Appreciate it.
Yeah, Josh.
Time now for what to watch. It's a big week for earnings, so let's start there. We're going to be hearing from a lot of prominent names, including Palantir on Monday, AMD on Tuesday, and Disney on Wednesday. Palantir announced results for second quarter. Analysts expecting Palantir's U.S. commercial business to post strong results for the quarter, but also see it growing more slowly overseas as it faces new competition in government contracts from companies like OpenAI, Google, and xAI. And moving over to the Fed, we're going to be getting some Fed commentary on Thursday from Atlanta Fed President Raphael Bostic. It's coming after some shakeups at the Federal Reserve. Fed Governor Adriana Kugler announcing on Friday her resignation effective August 8th. The Fed holding interest rates steady at Wednesday's FOMC meeting. Fed Governors Christopher Waller and Michelle Bowman disagreed with the decision, preferring to cut rates by a quarter percentage point. Fed Chair Jerome Powell saying in his post-decision press conference that no decisions have been made on a potential September rate cut. And taking a look over at the monthly consumer credit data for June is coming out on Thursday. Economists forecasting that number to rise to 7.1 billion, suggesting consumers are taking on more debt, which could signal more confidence in the economy. It's a big blow for Tesla. The company is ordered to pay millions of dollars over a fatal autopilot crash from 2019. A federal court jury finds Tesla's autopilot driver assistance feature was partially liable in the 2019 crash that killed one person and left another injured. In a complicated verdict, the jury found Tesla 33% to blame for that 2019 Florida crash. The jury determined that the Tesla driver was 67% responsible for the crash and awarded $42.5 million to compensate the victims for their losses, as well as $200 million in punitive damage against Tesla. Lawyers for the plaintiffs say that the verdict holds, quote, Tesla and Musk accountable for propping up the company's trillion-dollar valuation with self-driving hype at the expense of human lives. In 2019, the driver of Tesla relied on the car's autopilot driver assistance system when both the driver and the car failed to stop at a red light, driving through an intersection, striking an SUV, and killing a passerby. In a statement issued by Tesla, the electric vehicle manufacturer saying the verdict was wrong, and it plans to appeal the verdict, quote, given the substantial errors of law and irregularities at trial. Tesla says the verdict is an attempt to set back the automotive space in autonomous driving. Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.